Hello everyone, this is Rob McDougall with Zhang Financial here with your weekly economic update. Today is Monday, September 16th, 2024. So last week, after a huge down week the prior week in U.S. equities, we had a very strong rebound in both U.S. equities and U.S. fixed income markets last week, based largely on increased conviction that the Federal Reserve this week, on Wednesday, will take down interest rates here in the U.S. by 50 basis points. So the economic data that we had last week, a bit mixed, but the market clearly took it as a positive. So the big news last week, as we had previewed, there were two inflation indicators, CPI, core and headline, and also PPI, producer price index, that came out last week. They were pretty much in line. The August CPI numbers and core numbers, the actual CPI core number was a little higher than expected. It was expected to be positive 0.2 month over month, but it came in at positive 0.3. But in terms of the math, it was virtually where it was expected to be on a year-over-year basis, up 3.2%. So the PPI, which came out the next day, which was Thursday, and core PPI both came in as expected in terms of month over month, but actually a little bit favorable on the year-over-year. Core PPI came in at 2.4% year-over-year versus expectations of 2.5%. So the market took those inflation numbers as a positive during the week. And then also we had a couple of, I'd say, pretty neutral indicators, but didn't hurt the market for sure. Jobless claims, which we've been tracking more diligently now, 230,000 for the prior week, which is exactly as what was expected. And on Friday, we got the University of Michigan Consumer Sentiment Index, and that came out a little bit better than expected. It was expected to be 68. It came out at 69 even, so slightly favorable there. In terms of the U.S. economy, there is a lot of angst in the market about the U.S. economy and the strength, and a lot of talk about recession, soft landing. Again, we're not saying that's not going to happen in terms of recession or whether it's a soft landing. We are not seeing any of these metrics really show up in economic indicators. We talked about the U.S. non-farm payroll, the labor numbers, which we didn't have a lot of confidence in the first place. That's about the only place we've seen weakness in data. So again, every week we look at the Atlanta Federal Reserve, see what they think about the U.S. economy, and for the third quarter that we're currently in, that ends at the end of this month, they still believe the U.S. economy will grow at a 2.5% annualized clip. That's really strong. In terms of inflation expectations, a little uptick last week, but we're at very low levels. We're at an expected 2.08 inflation over the next 10 years. That's very favorable. And again, the markets, part of why they were so strong is an increased expectation of the Federal Reserve getting more aggressive in the rate cuts. So the Federal Open Market Committee meeting starts tomorrow. On Wednesday, they come out with a rate decision. The probability of 2 rate cuts being announced on Wednesday has increased significantly. It was 30% probability just 1 week ago. That has risen to 65% probability. So very strong likelihood the Federal Reserve takes 2 rate cuts. Then when we take a look at the end of the year, and we've been focusing, maybe we should expand this a little bit, but we've been looking at the potential for 4 rate cuts in total between now and the end of December. So the expectation for those 4 rate cuts, that's increased to 94%. So prior week it was 88%. So we're very strongly inclined to believe we're going to get those 2 rate cuts on Wednesday, and then at least 2 more by the end of this year. So markets loved it, obviously. S&P 500 up strong last week. Bloomberg U.S. Aggregate Bond Index up. So for the S&P 500, up over 4% last week. So now on a year-to-date basis, S&P 500 is up 19.1%. That's a very strong number. During the week last week, we did have a reversion. So value had a very nice run over the last couple of months. Investors went back to the Magnificent Seven and large cap, or I should say mega cap growth names. So last week in the U.S., growth up nearly 5.7%, value up only 1.3%. In terms of world markets last week, they were up, but not nearly as strong as the S&P 500. So developed markets ex-US up 1.35%, emerging markets up 0.7%, and below that was China down 50 basis points on the week. So China now year-to-date is down about 1%. And again, on a year-to-date basis, the S&P 500 up 19.1%. In terms of fixed income, last week both the 2-year and the 10-year yields came down another 6 basis points each. So the Bloomberg U.S. Aggregate Bond Index last week up 0.5%, 0.5%, and on a year-to-date basis up 4.93%. So let's move forward, take a look at the economic data that's expected to hit this week. Not nearly, I don't think, as impactful as we saw last week, but the biggest factor by far is the Fed decision on Wednesday. Not just a decision, but then the commentary that they will provide in a press conference after the release of whatever rate decision that is. So that is by far the biggest, but then on Tuesday, so tomorrow, retail sales come out, and that's going to be an important metric, particularly for those that expect the U.S. economy or believe the U.S. economy is decelerating significantly. So retail sales month over month in the month of July was up 1% month over month. The expectation for August is that it slowed to a positive 0.2%. If we strip out autos from that, retail sales ex-auto in July up 0.4%. That is also expected to decelerate, not as much, but down to positive 0.3%. We also have initial jobless claims this week, as we do every week. Again, last week was 230,000, exactly where consensus was. Same expectation this week, 230,000. Now, for the rest of the week, we've got 3 data points in terms of housing, and those are mixed. So we have building permits and housing starts that hit on Wednesday. Then on Thursday, existing home sales, just marginal changes. Building permits and housing starts are expected to be slightly stronger for the month of August versus July. And then existing home sales for the month of August is expected to be down a little bit from the month of July. So that's it in terms of the economic data that's coming out this week and a recap of last week, including returns. So thank you very much for your attendance, and we hope to see you next week. Thank you.